There's a date coming that over 1 million people in this country will miss. Not because they forgot, not because they do not care, because they genuinely do not understand that the deadline applies to them, what it requires them to do, or what happens the morning after it passes. Welcome back to HMRC Update, and today I want to talk about self-assessment, not in the vague, general way it usually gets covered, but specifically about where the system is right now in July 2026, which deadlines are immediately ahead, what changed in how HMRC handles non-compliance from April 2026 onwards, and the actions that separate the people who deal with this comfortably from the people who receive a penalty notice in the post and have no idea why. If you are not subscribed to HMRC Update, please do that now and turn on the bell. The self-assessment rules changed this year in ways that most people filing a return have not been told about, and those changes affect the penalty you face if something goes wrong. Subscribe. Let us get into it. Let me start with something that should be simple but consistently catches people out. The UK tax year runs from the 6th of April to the 5th of April. For the 2025 to 2026 tax year, the one that ended on the 5th of April this year, the paper filing deadline is the 31st of October 2026, and the online filing and payment deadline is the 31st of January 2027. Those are the two dates that govern almost every self-assessment filer in the country right now. If you file on paper, and a small but significant number of people still do, particularly older filers who have never switched to online, the 31st of October 2026 is the date that matters, and it is 3 months away. Miss it and an automatic £100 penalty applies from the 1st of November, regardless of whether you owe any tax at all. The paper deadline is earlier precisely because HMRC needs time to process manual returns before January. It is not flexible, and HMRC does not grant
extensions because you were not aware the earlier date existed. If you file online, which is the majority of self-assessment filers, the deadline is the 31st of January 2027. That sounds distant from where we are in July 2026. It is not. Here is why that matters right now rather than in December. HMRC will use your 2024 to 2025 tax return to determine whether you need to comply with Making Tax Digital for income tax from April 2026. That means the return covering the year that ended in April 2025, which for online filers is due by the 31st of January 2026 and should already have been filed, is the data point HMRC is using right now to determine who falls into the new Making Tax Digital regime and who does not. If you have not filed that return, or if you filed it inaccurately, your Making Tax Digital position is based on incomplete or incorrect data. That creates a compliance problem that compounds across multiple years, not just one. In January 2026, over 1.2 million people missed the 31st of January deadline. Of those 1.2 million, a very large proportion will still not have filed. Every month that passes without filing adds to the penalty position, and the penalty structure in 2026 is not the same structure many people remember from previous years. Here is what the penalty framework looks like today, and why acting now matters more than it used to. The self-assessment late filing penalty is triggered at midnight on the day after the deadline. The £100 fine is automatic and is issued regardless of whether the individual owes any tax or is due a refund. That is the entry point. It does not scale based on what you owe. It applies whether your liability is £50,000 or zero. After 3 months, daily penalties of £10 are charged for up to 90 days, totaling a maximum of £900. After 6 months, a further penalty of 5% of tax overdue, or £300, whichever is higher, is added. After 12 months, another 5% or £300 penalty applies on top of that. A return not filed
for a full year can carry combined filing penalties of over £1,600 before the underlying tax and interest are even calculated. And the late payment interest rate confirmed by HMRC from January 2026 is 7.75%, charged from the day after the payment deadline on any outstanding tax. The important thing to understand about those penalty figures is that they are not negotiable in the standard sense. They are automatically generated by HMRC's systems. They do not require a human decision. They do not arrive because HMRC investigated you. They arrive because a deadline passed and a return was not filed. The only route to having them reconsidered is a formal appeal on grounds of a reasonable excuse, and the bar for what qualifies as a reasonable excuse is significantly higher than most people assume. HMRC's confirmed list of what qualifies as a reasonable excuse includes serious illness,
bereavement of a close relative immediately before the deadline, unexpected hospital admission, and certain technical failures with HMRC's own systems. It does not include forgetting the deadline, not knowing you needed to file, being busy with work, or having difficulty gathering your records. Those are all understandable circumstances. None of them meet the legal threshold for a successful reasonable excuse appeal. An appeal must be submitted within 30 days of receiving the penalty notice and must be supported by evidence. Drop a comment below if you have received a self-assessment penalty letter and did not know you could appeal it. I want to understand how many people watching this channel are sitting on a penalty that could potentially be challenged. Back to what you need to do now. There is a second group of people who need to hear this today, and it is a group that does not realize it exists yet. If you have never filed a self-assessment return because you have always been employed under PAYE, because your only income has been your state pension, or because you have not
thought about it, there are specific circumstances that trigger a new obligation to register and file, and those circumstances are catching people in 2026 who have never dealt with HMRC in this way before. HMRC requires self-assessment from people whose tax situation cannot be handled entirely through pay-as-you-earn. You must send a return if any of the following applied during the previous tax year: self-employment with gross income above £1,000, untaxed income above £2,500, savings and investment income above £10,000, or income above £100,000. The one that is generating the most new self-assessment obligations in 2026 for people who have never filed before is savings interest. Because the personal savings allowance has been frozen at £1,000 for basic rate taxpayers since 2016, while savings rates have risen sharply, a very large number of people whose only income is a state pension and savings interest are now sitting above the threshold where HMRC requires a return. The obligation to register for self-assessment where untaxed income exceeds £2,500 is absolute. It does not matter that the person has never filed before. It does not matter that they had no idea they had crossed a threshold. The legal obligation exists from the end of the tax year in which the income arose, and the deadline to notify HMRC is the 5th of October following that tax year. For savings interest arising in the 2025 to 2026 tax year, the year that ended in April 2026, the notification deadline is the 5th of October 2026. That is 10 weeks away. If you have savings generating more than £2,500 of interest above your personal savings allowance and you have not notified HMRC, that deadline is the immediate priority. Notify HMRC by registering for self-assessment at gov.uk. The registration process takes approximately 10 minutes and generates a unique taxpayer reference, which is the number you need to file your return. Now, here is the change from April 2026 that most self-assessment filers have not fully absorbed, and that changes the penalty landscape significantly for a specific group. From April 2026, HMRC began introducing a penalty point system for late submissions as part of Making Tax Digital reforms. Instead of issuing a fine immediately after a missed deadline, taxpayers accumulate penalty points each time they submit late. A financial penalty is only issued once a threshold is reached. For taxpayers filing annually, 2 penalty points trigger a fine. For quarterly filers, 4 penalty points trigger a fine. Once the threshold is reached, a £200 penalty is applied, and each additional late submission results in another £200 penalty until compliance improves. Penalty points expire after 24 months, provided the threshold is not reached. What this means in practice is that annual self-assessment filers, people filing one return per year, now have a 2-strike structure before the financial penalty lands. Miss one deadline, receive 1 point. Miss a second, receive the second point and a £200 fine. Every subsequent late filing after that carries another £200 penalty. The old £100 automatic fine on the first day applies alongside this for the current year's return. The two systems operate in parallel during the transition period. The key practical point is that the points accumulate silently. You do not receive a letter when point 1 is added. You receive the financial penalty when the threshold is reached. By that point, 2 years of late filing are already on your record. For people who have been filing late for several years and assumed it was simply a matter of paying the £100 fine each time, that calculation has changed. The point system means repeated late filing now builds toward a compounding penalty position that is significantly more expensive than the entry-level £100 they have been paying. The correct response to any of these situations, a return not yet filed for 2024 to 2025, a new obligation arising from savings, interest, a penalty letter already received, or a Making Tax Digital obligation from April 2026, is the same in each case. Act now rather than later. The cost of acting now is the time it takes to file the return, make the payment, or set up the arrangement.
The cost of acting later is measured in pounds that compound every month. If you have a self-assessment return outstanding and cannot pay the tax owed in full, the most important thing is to file the return first. Filing and not paying is a better position than not filing and not paying. A filed return with an outstanding payment balance triggers only late payment interest at 7.75% from the due date. An unfiled return triggers the full filing penalty structure on top of the payment interest. File first. Then contact HMRC's payment helpline on 0300 200 3822 and ask about a time to pay arrangement. HMRC will agree monthly installments based on what you can realistically afford. A time-to-pay arrangement agreed before HMRC initiates enforcement prevents the late payment penalties from being applied on top of the interest already accruing. If you have received a penalty notice and believe you have a reasonable excuse, genuine illness, bereavement, or a technical HMRC system failure at the point of submission, you have 30 days from the date of the penalty notice to submit a formal appeal. The appeal goes to HMRC directly through your online account or in writing. Evidence matters. A letter from a doctor, a death certificate, or a screenshot of an HMRC system error message are the kinds of documentation that support a successful appeal. A statement that you were busy or did not know the deadline does not. So here is where this all sits and what you need to do with it today. If you have not yet filed your self-assessment return for the 2024 to 2025 tax year, the year ending April 2025, file it now. The paper deadline is the 31st of October 2026. The online deadline is the 31st of January 2027. Every month of delay adds to the penalty exposure. If you have already missed the January 2026 deadline for the 2024 to 2025 return, you have accrued at least a £100 fine already. File immediately to stop the daily £10 penalties from running further. If your savings interest for 2025 to 2026 exceeded £2,500 above your personal savings allowance and you have not yet filed a self-assessment return before, notify HMRC by the 5th of October 2026 by registering at gov.uk. That deadline is 10 weeks away. If you received a penalty notice and believe you have a reasonable excuse, appeal within 30 days with supporting evidence by contacting HMRC on 0300 200 3310. If you owe tax and cannot pay in full, file your return first and then contact the Time to Pay helpline on 0300 200 3822 to agree a payment plan before enforcement begins. And if your gross self-employment or property income in 2024 to 2025 exceeded £50,000, you are now in Making Tax Digital for income tax from April 2026. Quarterly updates are required through compatible software. The first quarterly deadline was the 7th of August 2026. The penalty easement for quarterly submissions applies for this first year only. The final declaration deadline of the 31st of January 2028 carries immediate financial penalties. HMRC does not send personal reminders before filing deadlines. The dates are published. The obligations are yours to identify. The penalties are automatic. The cost of missing a deadline grows every month it remains unaddressed. You now know exactly where the deadlines sit, what they cost, and what to do right now to stay ahead of them. If this video helped you understand something you were not clear on, share it with someone who files self-assessment and has been putting it off. One conversation could save them a penalty that was entirely avoidable. Subscribe to HMRC Update if you are not already here.